So you've been thinking about buying a house and researching how much are the down payments. Well, congratulations, at least you are thinking about buying a house. But then you find out the house is going to be expensive. You find out there are closing costs. What are closing costs? Who pays for it? Does the agent pay for it? Do you as a buyer pay for it? Does the seller pay for it? Well, not to worry. In this video, I'm going to show you what the closing costs are, who pays for what, how much they are based on your purchase price, and go into details and show you exactly what the closing costs are. Welcome to my channel, by the way. I'm Mike Patel in Anaheim Hills, and I'm going to show you in details. Here's a sheet that we're going to go through of each cost when you buy a house, whether it's a $300,000 house or a $1 million house. So let's look at these closing costs that you are going to have to pay along with your down payment. So to give you an accurate amount of closing costs based on your purchase price, I'm going to take a couple of assumptions. I'm going to take a house price that you're going to purchase for $430,000, and I'm picking that number because the median home price as of Q3 is around $420,000. So I'm going to pick a $430,000 house. I'm going to assume that you're going to get a fixed loan and put 10% down at a 6.5% interest rate. So based on these assumptions, let's look at this chart and let's look at those closing costs item by item. So the first item we are going to look at is your down payment. And as I mentioned to you, we are going to assume that you're going to put 10% down on a $430,000 house. So based on that, your down payment cost will be $43,000 to purchase this house. Just to let you know what your monthly payments are, so you know when you buy this kind of house what your payments are. Your principal and interest will be $2446.10 a month. Your real estate taxes, which is the property tax, will be $394.17 a month. Of course, make an assumption that this is a 1.1% property tax. I'm in Orange County, California, so I'm using that percentage. But some other states and each county and state has different property taxes, so you can adjust it. But this is just to give an idea. There is also homeowners insurance that you are required to buy and pay, which is in this case $143.33 a month. And there's the MIP or the PMI, which is the private mortgage insurance. So if you get a loan, any kind of loan, and if your down payment is less than 20% of the purchase price, then the lenders require you to pay this insurance, which is the PMI. In this case, based on a $430,000 price, it comes out at $251.55. We are going to put homeowners association at 0 at this time, assuming that your house that you're going to buy does not have association fees. And we are also going to assume that there is no Mello-Roos. So your total monthly payments will be $3,235.15. Just on a side note, so if you're going to be paying $32.35 a month, approximately you should be making 3 times that amount for you to qualify, just to give you a heads up. So if you're making $10,000, you're okay to go up to $3,300 a month payment. The lenders will allow that, just to give you a frame of reference. So in closing costs, there are fixed costs and there are prepaid costs. Let's look at the fixed costs. So when you buy something, especially in California, we use escrow services. I know some of the states use an attorney, so it may be different, but this is just an example. So based on the purchase price of $430,000, the escrow fees, and which are pretty much similar to all the escrow companies they charge you, it's based on your purchase price. In this example, it'll be $1,300 a month. There is no owner's title policy. Usually the sellers pay that, but because you're a buyer, there's no cost to you. And then there's the lender's title policy, and that will be about $841 based on this price. The next item is what we call the origination fee. This is what the lenders charge. It's like a commission. They charge you. Of course, they may charge you 1%, they may charge you 2%, or they may charge you 0%. It's a negotiable item. But in this example, we're gonna say that the lender is charging you 1% of the loan amount, not the purchase price. So it's $38.70 fees because you're borrowing $387 to get the loan. Then we have the processing fee, the tax service contract fee, the document preparation fee, which I call them junk fees. These are fees that you have to pay. There's no way around it. It's also based on the percentage. Most of the costs are based on the percentage of your loan amount and your purchase amount. The next fee is what we call the underwriting fees. This is what the lender charges you to check all the paperwork and make sure everything's okay. They are qualifying you. There's so much paperwork. They call it the underwriting fee. In this case, it's $425. And then we have the appraisal fee. In this case, it's $475, which is required by the lender to do an appraisal. So it's $475. Then we have the credit report. They run credit reports. It's $60, assuming it's a couple, it's $30 each. It could be vary. If you're 5 buyers on the title, then there'll be 5 credit reports, so there'll be additional charges. Then we have the home warranty. Usually this is paid by the seller, but it's also a negotiable item. In this hot market where there's overbidding, some of the sellers get greedy. They get $50,000 more than what they got 2 years ago, and they won't even pay the home warranty fee. That's the market. But if you had to pay a home warranty, it runs around $500, depending if you have AC coverage, appliances coverage, roof coverage, etc. But let's take an average of $500. And by the way, a home warranty is like an insurance that you buy. So in case you buy the house and you move in and your dishwasher doesn't work or something goes wrong, then you can call the home warranty and they will fix it with a certain amount of deductible. So that's what it is. It's also a negotiable item. We as agents highly recommend, I recommend all my buyers to get the home warranty. If the seller does not pay for it, if the buyer doesn't want to pay for it, I take the extra step and try to pay the extra home warranty for the buyers as a token of appreciation. Then we go to some more junk fees, which we call the flood certificate, the endorsement fees, the notary signing fees, the new loan service fees. All these fees are junk fees. The new loan service fee is the escrow has to let the lenders know and the title company know that there's a new buyer and they have to do all the paperwork. So all these are junk fees, but they are fees that you have to pay, and they do add up. What I like about the next item is what we call the seller paid closing cost. Now this, usually when you have an FHA loan, which is a government loan, you can ask the seller to pay for certain credits, pay for some closing costs, escrow fees. It's a negotiable item. In this example, I put that, hey, the seller was nice enough to pay $1,000, just helping you out paying because you paid full price or over full price that they were asking for, and you ask for closing cost of, let's say, $5,000, but they give you $1,000 if you were running short. Closing costs you usually ask when you are really running short on your funds, and a lot of the first-time buyers are barely making it. So it's a good gesture to ask, and some of the sellers pay for it, some don't. In a VA loan, which is the Veterans Administration loans, they put 0% down, and then a lot of times they ask the seller to pay the closing cost. So the VA buyer, in fact, I have one in escrow right now with another agent. He's putting 0% down, and there's about $8,000 or $9,000 in closing cost, and we have asked the seller to pay for it, and he's actually paying for it. So this house that we sold in the desert area for $435,000, he's gonna go in with 0% down and 0 closing cost, maybe some cost here and there, but pretty much 0. But that can only happen in a VA loan. So asking for credit is a good thing if you can get it. Moving on to the next line item, we can see that there are sub escrow fees and there's the SB2 recording fees. All these are fees the escrow charges you to file certain things with the county or the title company or other paperwork that has to be done. I won't get into too much details because I'm more concerned about the cost rather than what it is exactly. But at least you know that there's other fees, not just the escrow fees of $1,300 that we talked about. Then the other fees that should be there all the time is the inspection fees. So when a buyer buys a house, at least in California, we recommend to every buyer to do a home inspection. Of course, you may be a contractor or handyman and you know about construction, etc. You are welcome to do the home inspection, but we recommend as agents all home buyers to get a professional inspection. So what they do is they come in the house, they check the faucet, they check the electrical, they make sure the faucets are working. These days with high tech, they point a laser beam or a sensor on the wall in the bathroom, and they can tell if there's a moisture in the wall. They can sense how much the air is blowing for the air conditioning. So there's a lot of things we recommend, and they will give you a report. At the end of the report, if these things needs to be fixed, you can negotiate with the seller for credit or have them repair it. So we highly recommend the inspection fee. In California, they run anywhere from $400 to $500, and it depends on the size of the house. If you have a jacuzzi, if you have a pool, then there's extra cost. Then we also recommend what we call a pest report. Usually the sellers used to do this. We want to make sure that when you buy a house, there's no termite or pest in the house. So we usually ask the seller to do that. These days, because of the hot market and bidding wars, they're not paying for anything. They don't pay for home warranty. They don't pay for termite. They don't pay for repairs. So in this case, it may cost you $100. If there is work to be done, that's additional cost. So those are basically the fixed cost. So let me just give you a summary. So based on this price of $430, your fixed cost in this case amounts to $10,826. And I'm going to talk about next the prepaid cost. What are prepaid costs? Well, there are two prepaid costs. So talking about fixed costs, there are two kinds of fixed costs. One is the property taxes that you have to pay, and the second one is the insurance that you have to pay. So in California and most of the states, you have to pay 6 months of property tax ahead of time in arrears. That means that if you buy a house right now, you have to pay 6 months ahead. In California, the property tax is 1.1%. So on a house that is priced at $430, your property tax will be $23.65 for 6 months of taxes. So that's a fixed cost that you have to pay ahead at the time of closing. So you need additional $23.65 when you purchase this house. The other cost is the lenders want you to pay 12 months of insurance ahead of time. Not when you start, but they want you to pay 12 months of insurance ahead of time based on your loan amount, not your purchase amount. And in this example, it comes out to $1,720. And then depending on the interest, when you close, there are prorated interest rate and other interest costs that you may have to pay upfront. In this case, the example shows 30 days of interest that you have to pay upfront, which is $20.96. And then they want you to pay 2 months of private mortgage insurance. This applies only if you put less than 20% down. So 2 months in this case will be $503.10. So your total prepaid cost based on a loan amount of $387,000 and a purchase price of $430 is $6684.35. So those are your prepaid cost. So if you add the fixed costs and the prepaid cost, your total cost is $17,510. Now you have to add your down payment that you are going to put, which is $43,000. So the total money you have to come up with is approximately $60,000, $510.35 to close this escrow to buy this house, which is a lot of money, but it could not be a lot of money. And to reduce this amount, I gave an example of 10% down. If you have more money, you can put 20% down or 50% down. A lot of people in Orange County, for example, are putting 20, 25, 30, 35, 40% down. Very common. But a lot of the other home buyers, first-time home buyers, are also putting 3.5% down, which is the FHA loan. So if you put a 3.5% down on a $400,000 house, it's approximately $15,000 and not $43,000. And then if you add your closing cost, which will be a little bit more than $17,500 because there's other costs with an FHA loan, but you will be close to $30,000 or $32,000 versus $60,000. So FHA loan is a great way to buy your first home. If you need information on FHA loan, direct message me and I'll give you some more information on it. I just wanted to take a few more minutes and give you another cost that a lot of buyers don't think about and nobody talks about. Lenders don't talk about it. Other realtors don't talk about it. But since I'm talking about cost, I wanted to let you know there's other costs that you want to consider. Of course, your first cost is your down payment. On a $430 house at 10%, you need $430,000. At 3% down or 3.5% down, you need about $15,000 down. Then you have closing costs, which range anywhere from average of 1.5 to 3% of your purchase price of your home. And then what is the other cost? Well, when you buy a house, you're going to have to move from your apartment, or if you're staying with your parents or your friends, to the new house. There's moving cost. And the moving cost includes all the things you have to put in your pickup truck or U-Haul truck. You have to rent the truck. Then you have to go to the house, add on the utilities, add on the streaming services. You may want to patch up some things. You know, the bathroom had a leak and you have to fix this before you move in. You have to buy some furniture and fixtures because you're buying from a 1-bedroom to a 3-bedroom or a 2-bedroom to a 3-bedroom because you have a kid or you have some people coming in, so you have to buy extra furniture, extra appliances, extra utensils. So those are what we call moving costs. So please account for that as well. And I also recommend as a second bonus that you have some reserve money saved up. So on a 10% down example of $430, you need $60,000 plus you may need anywhere from $2,000 to $10,000 moving cost. But we highly recommend that you have 3 months of mortgage payment at least reserved for safety in case something happens, you lose a job or there's a medical emergency or any kind of emergency. Have some money left over. I know it sounds like a lot of money, but hey, buying a house is not easy, but it's the American dream. And you have to do everything you can to buy the house because it will appreciate and build you wealth in the long term. Also, if you're thinking of buying a house maybe 6 months from now or 3 years from now and want a sheet that shows you what your expenses will be, email me. My contact info is right here on the screen. Email me or call me and I'll give you a sheet and explain to you the expenses. I'll be glad to do that. And also, if you're looking for a house or a lender, I belong to a national network of lenders and realtors, and I can refer you to somebody locally that's a great agent, a professional agent and a skilled agent or lender that can help you out. Thanks for watching. Also, please watch this video. It talks about when is the right time to buy a house.